To understand the core of Benjamin Graham's philosophy, one must first understand the psychological traumas that forged it. His relationship with the market was defined by two catastrophic events that shaped his entire worldview. He was born in 1894, and his first formative experience with financial risk came as a young boy during the panic of 1907. His father had died, and his widowed mother, trying to support the family, had invested their entire savings in the stock market. When the panic hit and the market crashed, their fortune was completely wiped out. This early exposure to the devastating consequences of market volatility, the searing memory of his family's ruin, instilled in him a deep and abiding respect for the concept of risk, not as an abstract number, but as a force that could destroy lives. This experience propelled him to excel academically. He was a brilliant student, graduating second in his class from Columbia University and immediately receiving offers to teach from 3 different departments. But he chose to go to Wall Street, starting as a clerk, and quickly rising through the ranks due to his formidable intellect. He became a successful money manager in the heady, speculative environment of the 1920s. But it was the second great trauma, the great crash of 1929 and the ensuing Great Depression, that would be the final defining catalyst for his life's work. Despite his intelligence and success, he was not immune to the collapse. He suffered devastating financial losses, a painful and humbling experience that proved to him that the existing methods of operating on Wall Street, methods based on intuition, speculation, and bullish optimism, were fundamentally flawed and incomplete. He concluded that the entire profession lacked a rigorous intellectual foundation. His mission, born from the ashes of the crash, was to create one. He sought to transform security analysis from a form of speculative art into a true profession, with its own set of principles, ethical standards, and a repeatable logical process. His first step was to correctly diagnose the problem. Why were markets so prone to these wild, destructive swings? Graham concluded that the extreme volatility of the market was not a reflection of any rational, rapid changes in the underlying value of businesses. Businesses, for the most part, evolved slowly and predictably. The chaos, he realized, was a reflection of the unstable and deeply irrational psychology of the market's participants. He saw that the market was governed not by logic, but by the powerful, primal, and often self-destructive human emotions of greed and fear. During a bull market, he observed that greed takes over. Investors, seeing prices rise, abandon all discipline and skepticism. They begin to believe in new eras of permanent prosperity. They extrapolate recent success into the indefinite future, and they become willing to pay any price for a stock, driven by the fear of missing out on easy profits. During a bear market, the pendulum swings to the opposite extreme. Fear becomes the dominant emotion. Investors, seeing prices fall, forget all notions of long-term value and project the current crisis into the future forever. They capitulate, selling their holdings in a panic, often at prices far below their tangible worth, driven by the overwhelming fear of total ruin. To capture this fundamental insight, Graham created one of the most powerful analogies in the history of finance, his distinction between the voting machine and the weighing machine. He famously stated, "In the short run, the market is a voting machine, tallying up registrants who are optimistic and pessimistic. But in the long run, the market is a weighing machine." This simple statement is a profound deconstruction of market behavior. The voting machine describes the short-term, speculative nature of the market. On any given day or month, a stock's price is a reflection of its popularity, of the votes of thousands of participants driven by hope, fear, tips, and narratives. This is the chaotic, unpredictable world of Livermore. But the weighing machine describes the market's long-term investing nature. Over a period of years, the market will eventually and inevitably recognize the true underlying weight of a business, its earnings, its assets, and its cash flows. The noise of the voting machine will fade, and the reality of the weighing machine will prevail. Graham's entire philosophy was designed to ignore the confusing and misleading signals of the short-term voting machine and to focus solely on the long-term, verifiable reality of the weighing machine. Having diagnosed the problem of an emotionally driven market, Graham developed his first and most important solution, the principle that is the bedrock of all true value investing. This is the concept of the margin of safety. In its simplest form, the margin of safety is a favorable difference between the price of a security and its indicated or appraised intrinsic value. It is the discipline of buying an asset for significantly less than you believe it is worth. If you calculate a business to be worth $1, you should seek to buy it for 50 cents. That 50-cent discount is your margin of safety. While this sounds like a simple financial calculation, for Graham it was a profound philosophical and psychological tool. It was his primary defense against the chaos he had experienced in his own life. The first and most obvious function of the margin of safety is protection against error. Graham was a man of immense intellectual humility. He knew that calculating the precise intrinsic value of a business is an imprecise art, not a hard science. He knew that his own analysis could be flawed, that he could make mistakes in his calculations, or that he could overlook a hidden risk. The margin of safety was the buffer for his own fallibility. If he bought a stock he thought was worth $1 for 50 cents, and it turned out his analysis was slightly off and it was only worth 80 cents, he still had a high probability of making a profit. The discount protected him from the consequences of his own inevitable mistakes. The second function is protection against bad luck. Graham understood that the world is an unpredictable place. A company can be hit by unforeseen negative events, a new competitor, a disruptive technology, a sudden recession. These events are by their nature unknowable. The margin of safety provides a crucial cushion against the slings and arrows of outrageous fortune. A large discount provides the resilience needed to withstand negative surprises without suffering a permanent loss of capital. But the third, and for our purposes, the most important function of the margin of safety is its role as a psychological shield. It is the tool that gives the investor the courage to act rationally when others are consumed by emotion. To buy stocks during a market crash, when the news is terrifying and the consensus view is that the world is ending, is an act of immense psychological difficulty. The only way to do so is to be anchored to a rational, objective calculation of value. The margin of safety provides this anchor. Knowing that you are buying $1's worth of assets for 50 cents gives you the profound, unemotional confidence to act as a buyer when everyone else is a panicked seller. Similarly, it provides the patience to hold through volatility. If a stock you bought for 50 cents falls to 40 cents during a market dip, but your analysis of its $1 intrinsic value remains unchanged, the margin of safety gives you the emotional fortitude to not panic sell. It transforms you from a victim of the market's mood swings into a disciplined, objective operator. This principle of building a defensive shield against both market volatility and your own emotional reactions is the hallmark of a professional operator. It is not a lesson learned once, but a mental discipline cultivated over a lifetime. To continue building these habits of disciplined, risk-averse investing, and to learn from the methods of the market's greatest masters, we invite you to subscribe to this channel and click the notification bell. Join our community of serious market participants. Having built his defensive shield, the margin of safety, Graham then created his most famous and enduring teaching tool, a brilliant allegory designed to personify the very market irrationality he sought to exploit. This is the parable of Mr. Market. Graham asked his students to imagine that they owned a share in a private business, and that they had a partner named Mr. Market. This partner is a very obliging fellow. Every single day, without fail, he comes to you and tells you what he thinks your shares are worth, and he offers to either buy you out or sell you his shares at that price. However, Mr. Market has a profound psychological problem. He is a manic-depressive. On some days, driven by uncontrollable euphoria, he shows up at your door overcome with optimism. He sees only a bright and prosperous future for your business, and he quotes a ridiculously high price for your shares. On these days, the intelligent investor is free to sell their shares to him, taking advantage of his foolish optimism. On other days, he arrives in a state of deep, inconsolable despair. He sees only trouble and ruin ahead, and in his panic he offers to sell you his own shares at an absurdly low price. On these days, the intelligent investor is free to buy his shares from him, taking advantage of his foolish pessimism. The most important thing to remember, Graham taught, is that Mr. Market is your servant, not your guide. You are under no obligation to trade with him. If his daily price quotes seem nonsensical, you are free to ignore him and wait for him to come to his senses. The great mistake that most people make is that they allow themselves to be influenced by his moods. They feel euphoric when he quotes a high price and fearful when he quotes a low one. They let his irrationality dictate their own emotional state and, consequently, their investment decisions. This simple but powerful allegory is a complete psychological framework for dealing with market volatility. It teaches several profound lessons. First, you are in control. You have the power to accept or reject Mr. Market's daily offers. You are not forced to trade at his prices. This simple realization is a powerful antidote to the feeling of helplessness that many investors experience during volatile markets. Second, his mood is an opportunity, not a source of information. You must form your own independent opinion of your business's value based on your own research. Mr. Market's daily price quote is not a reflection of that true value. It is merely a reflection of his emotional state. The intelligent investor uses his emotions as a contrary indicator. Third, volatility is your friend, not your enemy. The more manic-depressive Mr. Market is, the more opportunities he will present to the rational, disciplined investor. A volatile market, far from being a risk, is the source of the greatest bargains. This is a complete inversion of the common view of market behavior. The parable of Mr. Market is a tool for achieving a state of psychological detachment, for viewing the market not as an all-knowing God whose judgment must be respected, but as a fallible, emotional, and ultimately exploitable business partner. Now we move from the world of defense and philosophy to the world of practical operational strategy. It is not enough to simply understand Mr. Market. One must have a clear and systematic plan for exploiting his folly. Graham understood that not all investors have the same amount of time, skill, or temperament. He therefore created two distinct paths for the intelligent investor, two different sets of rules for engaging with and ultimately beating Mr. Market. In this second part of our masterclass, we will deconstruct both of these paths, the simple, disciplined, and powerful strategy of the defensive investor, and the more complex, research-intensive, and potentially more rewarding strategy of the enterprising investor, culminating in his ultimate method for finding deep value, the famous net-net approach. Graham's first path was designed for the majority of people. The defensive investor is his term for the individual who is not a full-time financial professional, someone who seeks a safe, reliable, and largely hands-off return on their capital. The primary goal of the defensive investor is not to achieve spectacular market-beating returns, but to achieve satisfactory results while avoiding serious mistakes and the permanent loss of capital. The strategy he laid out for this persona is a masterclass in simplicity, discipline, and the power of building a fortress of rules that protects the investor from both market volatility and, more importantly, from their own worst emotional impulses. The defensive investor beats Mr. Market not by outsmarting him in a fast-paced game, but by refusing to play his short-term game at all. The first pillar of the defensive investor's strategy is adequate diversification. Graham was adamant that attempting to pick a single winning stock was a fool's errand for the non-professional. The future is uncertain, and even the most seemingly stable company can be upended by unforeseen events. Diversification is the primary defense against this single company risk. He suggested holding a portfolio of between 10 and 30 different stocks. This is enough to ensure that the failure of any one company will not have a catastrophic impact on the overall portfolio, but not so many that the investor loses track of what they own. He also advocated for a simple, balanced portfolio often suggesting a 50-50 split between high-quality stocks and high-quality bonds, with a rule to rebalance when the allocation strayed too far, a simple mechanism for forcing the investor to sell stocks when they are high and buy them when they are low. The second pillar is a strict focus on large, prominent, and conservatively financed companies. The defensive investor is not in the business of speculating on small, unproven enterprises. Their portfolio should be built on the bedrock of the economy's most established and durable businesses. Graham laid out a clear set of criteria for selecting these companies. He insisted on a minimum size to ensure stability, a long, continuous history of dividend payments, he suggested at least 20 years, to prove financial strength and a commitment to shareholders, and a strong balance sheet with low levels of debt. This was a powerful filter designed to weed out the speculative, the weak, and the unproven. The third and most critical pillar is a strict ceiling on the price to be paid. This is the mechanical application of the margin of safety. The defensive investor does not need to perform a complex, detailed valuation of every company. Instead, Graham provided a set of simple, conservative heuristics to prevent them from overpaying, even for a high-quality business. For example, he suggested that a defensive investor should not pay more than 25 times a company's average earnings over the past 7 years, and not more than 1.5 times its book value. This simple rule would have kept investors out of the euphoric, high-priced markets that preceded major crashes, acting as a powerful automatic brake against market mania. The final component of the defensive investor's strategy is the powerful, automated tool of dollar-cost averaging. Graham was a strong proponent of investing a fixed amount of money at regular intervals, for example, monthly or quarterly, regardless of the market's current level. The genius of this approach is that it automates the process of exploiting Mr. Market's moods. When Mr. Market is pessimistic and prices are low, the investor's fixed dollar amount automatically buys more shares. When Mr. Market is euphoric and prices are high, the same fixed dollar amount buys fewer shares. This simple disciplined process ensures that the investor's average cost per share will be lower than the average price over time. It is a brilliant mechanical system for turning market volatility from an enemy into an ally. Taken together, these rules form a complete, self-contained system. The defensive investor wins not by being smarter than Mr. Market, but by adhering to a simple, rigid discipline that insulates them from his emotional temptations and allows them to benefit from the long-term growth of the economy. While the defensive path was designed for safety and simplicity, Graham knew there was another type of investor, the one who was willing and able to devote the significant time and effort required to achieve superior, market-beating returns. This is the enterprising investor. The strategies for this persona are more complex, more research-intensive, and require a greater degree of business acumen. This is the path of the active, professional-grade value investor, and it is where we find Graham's most famous and powerful techniques for actively exploiting Mr. Market's deepest fits of despair. The ultimate strategy for the enterprising investor, the purest expression of the margin of safety, is the famous net-net approach, which is often called cigar butt investing. The logic behind this strategy is to find the most statistically undeniable bargains the market has to offer. Graham sought to buy companies for a price that was significantly below their net current asset value, or NCAV. This is a very specific and highly conservative measure of a company's liquidation value. The calculation is simple but brutal. One starts with a company's current assets. This is its cash, its accounts receivable, money owed to it, and its inventory. From this, one subtracts the company's total liabilities, including all long-term debt and preferred stock. The number that is left is the net current asset value. Graham, being exceptionally conservative, would often apply further discounts. For example, he might value the accounts receivable at only 75% of their stated value to account for potential defaults, and he might value the inventory at only 50% of its stated value, as it might have to be sold at a deep discount in a liquidation. The final adjusted number represents a rock-bottom, fire sale estimate of what the company's liquid assets are worth. The net-net strategy was to buy a stock for 2/3 or less of this calculated value. The genius of this approach is what it implies. An investor who buys a net-net is, in effect, purchasing a company's liquid assets for 67 cents on the dollar, and they are getting the entire productive long-term part of the business, its factories, its real estate, its brands, its patents, for absolutely free. This is the cigar butt analogy made famous by Warren Buffett. It is like finding a discarded cigar on the street that has one good puff left in it. You pick it up, take that one free puff, and then throw it away. The investment is not in a great business, but in a single, deeply discounted puff of profit. In Graham's time, during and after the Great Depression, the market was littered with these net-nets. The despair of Mr. Market was so profound that he was willing to sell entire businesses for less than the cash in their registers. An enterprising investor with a strong stomach and a calculator could systematically buy baskets of these stocks, and, as the economy recovered and sanity returned, realized substantial profits as their prices inevitably rose to reflect their true asset value. This strategy requires no forecast of future earnings or economic growth. Its success is based solely on the mathematical certainty of the balance sheet. Beyond the net-nets, the enterprising investor could also look for other opportunities in what Graham called special situations, or workouts. These are investments whose outcome is dependent on a specific corporate event, rather than the general mood of the market. The most common of these is risk arbitrage. When one company announces its intention to acquire another at a specific price, the stock of the target company will usually rise to a level just slightly below the deal price. The small gap reflects the risk that the deal might fall through. An enterprising investor could buy the target company's stock, and if the deal closes as expected, they would earn that small spread as a profit. It is a strategy that depends on the legal and financial probabilities of a deal closing, not on the direction of the S&P 500. The final component of the enterprising approach was to look for large, unpopular secondary companies. These are established, well-known businesses that are not statistically cheap enough to be net-nets, but which have fallen out of favor with the market due to a period of poor earnings or negative headlines. The enterprising investor would do the deep, fundamental research to determine if the company's problems were temporary and solvable or permanent and fatal. If they concluded the problems were temporary, they could buy a good business at a temporarily cheap price, a strategy that requires more qualitative judgment than the purely quantitative net-net approach. To successfully execute either of these strategies, but particularly the enterprising one, requires a specific set of psychological disciplines. These are the mental habits that an investor must cultivate to beat Mr. Market. The first is radical patience. One must be able to wait, sometimes for years, for Mr. Market to fall into a deep enough state of despair to offer up true bargains. The second is emotional detachment. One must be able to view Mr. Market's daily price quotes as just data points, not as a verdict on one's own intelligence. The third is profound contrarianism. One must have the psychological fortitude to be a buyer when the entire world is screaming sell, and to be a seller when the world is in a state of euphoria. The greatest student and practitioner of this entire philosophy was, of course, Warren Buffett. He began his career as a pure Graham disciple, running his Buffett partnership in the 1950s and 60s almost exclusively as an enterprising investor. He filled his portfolio with net-nets, special situations, and other deeply undervalued securities, using Graham's principles to generate a spectacular track record that laid the foundation for the Berkshire Hathaway empire. He was the ultimate proof of the power of Graham's methods. In conclusion, the legacy of Benjamin Graham is that he was the man who transformed investing from a dangerous and unpredictable speculation into a manageable, intelligent, and, for the first time, safe pursuit. His twin concepts of the margin of safety and Mr. Market are not just investment techniques. They are a complete psychological framework for achieving rationality in an irrational world. He provided two distinct paths: the simple, disciplined approach of the defensive investor and the research-intensive, contrarian approach of the enterprising investor. that together offer a complete guide for anyone seeking to build and protect their capital over the long term. He was and remains the true father of value investing. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.